Hello. Hello. Hello, everyone. Welcome. You guys want to hear about how to save your property or how to survive a recession as a multifamily owner operator? You're gonna do me dirty here. You're gonna make me tell my old war stories and all the good, the bad, and the ugly, and what you do right and what you do wrong. God, I don't know if we have enough time on these types of calls. But in the meantime, let's let it build up here. Let it build up. Okay, so I'm gonna start talking. Halfway through, I'm just gonna take a break and I'm going to tell you about some of the events that we have coming up, just to keep everybody in the loop as to the upcoming summer series for the Multifamily OS and the Multifamily Investing Academy. If Molly is listening or Deb's online, they're listening. If somebody pops up a question on the sidebar, if you could just click on it as the producer and I can read it right on the screen. That way I won't have to go back to it like a Zoom call, like we do for Zoom. All right, so let's talk about recessions, because the way that this particular talk was worded had to do with, like, how are you going to protect yourself now? Well, if you made some of the same mistakes I made back in 2008, you're probably in for a world of hurt. It really depends upon what region or what market you're in, because this particular crash, and it's not going to be a crash, it's a turn. This particular turn in the economy is going to happen differently in different parts of the country. Back in 2008, it happened first out in California and then worked its way quickly across the country. Within about 6 months is when it all had pretty much shaken out. Here we just saw, Silicon Valley Bank crash and Signature Bank. And I just love it how, and now this is, I didn't check this myself. I got this information off the internet, so it's probably right. But obviously one of the reasons why Silicon Valley Bank went south was because they put some of their deposits in government bonds, and the value of those bonds went down as the inflation and as interest rates went up. That's what happens. So the bank was doing what they were told to do by the Dodd-Frank legislation that came out of 2008. And the second bank to crash, two biggest banks ever in the history of the country, crashed within the same week. The second bank was Signature Bank. And it's just so apropos that Barney Frank was on their board of directors. Oh, couldn't have happened to a nicer bank. Oh, anyway, okay, so let's talk about what happens with all this going on. So we've had a major heyday for the last, even leading up to COVID. Even leading up to COVID, multifamily was the charmed asset among all investors. It didn't seem that it could do any wrong. People were buying at incredibly low cap rates, and the interest rates were low, but there was a spread between the yield rate between the cap rates and the interest rates. So it was a win. People just kept buying and paying higher prices and paying higher prices. You bought a property 2 years ago, you could sell it and make a ton of money, and the next person was still going to offer their investors a 9% preferred pref because the rents just kept going up, and because the demand was so high and there was no place to live, people could keep charging higher and higher rents. All right, so some people were purchasing multifamily investments for the wrong reason. And that is that they figured that the rents would continue to go up and the values would continue to go up. And they counted their investment strategy was to take advantage of that continued growth. And so that's the worst type of investment strategy you have, is where you rely on future growth from a market that just seems like it's going to constantly into the stratosphere. Bad thoughts. Here's what's happening right now. Just saw a report that rents are starting to come down considerably. As a matter of fact, while we're talking, I'm gonna pull up that report, and you can all see it. Rents are starting to come down considerably. Vacancies are going up, which obviously that's a direct correlation between the two. We all know that. But that is going to start to change the look of some of these markets and some of these particular properties. And as the interest rates go up and the inflation continues to go up, those people that say there's no correlation between cap rates and interest rates are in for a world of hurt when they find out that that is not true. And that's just how this happens. Let me just do a quick little, see, because everybody wants this. Here it is right here. I got it right here in front of me. Landlords can't rent their apartments. Vacancies are surging. Let me tell you where the top towns are, the top cities. Well, obviously, Phoenix is one of them. Phoenix was the fair-haired child, could do no wrong. We saw rental increases go up double digits over and over, and sometimes in the 20% increase in rents. Phoenix, Las Vegas, and Jacksonville have crashing rental markets. Phoenix is a rough one in particular. Their apartment vacancy rate across the metro has skyrocketed from a low of 3.2 up to 7.2% in March. That doesn't sound like a lot. That's huge, folks. That is huge. This 7.2% vacancy rate is the highest level in this particular company's data set that goes back 6 years. And it suggests that we could continue to see rental rates decline in Phoenix as 2023 progresses. The typical monthly rent in Phoenix, according to Apartment List, has already declined from a high of $1,619 per month to $1,577. That's a 2.5% drop. Of course, the rents in Phoenix are still higher than they were pre-pandemic. But the recent declines in rent combined with increasing vacancies is a good start and suggests that landlords in Phoenix are going to have a tough time in 2023 and 2024. So we're starting to see it happen now. But let's talk about what goes on. First thing is you have to understand what bank or what lender these investors have signed on with. First off, the risky type of loans, like the bridge loans, the short-term loans, the ones that give a very high LTV, those are the first ones that are going to have the biggest problems as the markets start to change. Those are mostly on the GSE side, the government-sponsored entities, and less so on the local lender standpoint. And what happens is the local lender, when they gave those loans, the local lenders are very conservative. So they've built in some cushion. They give lower loan to values. They give higher interest rates. They give shorter terms and shorter amortizations. But regardless, anyone that went out and had a short-term bridge loan, like 2 to 3 years, or even a 5-year IO or a 5-year term with a government-sponsored entity, those people are going to be in for a world of hurt. And I'll come back to that in just a moment. But the difference between the two lenders is this. As the values of the assets come down, and they are coming down right now, because as the interest rates go up, the new investors looking to buy that property cannot buy as much property as before, not only because their dollars aren't doing as much as before with inflation, but also because the cost of borrowing is preventing them from buying as much property as they could before and giving the same type of return that their investors are looking for. And that's the key, is it all boils down to the investors. The investors are expecting a certain particular return every single year. And the only way that property can sustain that is ever increasing rents, or it was purchased at a lower price, and it will grow using all of the IRR benefits, the mortgage pay down, the forced appreciation. All of those things are going towards increasing the value of that property. if the rents continue to come down, those properties, let me just don't move my cursor, there we go. Those properties are just going to lose value. Now, if it's a CMBS note, and if I'm speaking too fast or you're not familiar with these terms, please chime in. A CMBS note, a commercial mortgage-backed securities, typically a government-sponsored entity, a Fannie or a Freddie Mac, those people don't care about the drop in the valuation. As long as you keep paying that monthly rent, you're all set. You're still in good stead with them. They will not have a cash call on your property as long as you're doing everything right. It's a different situation for a local lender who is governed by the state board, the state bank examiner. They live in fear of these guys coming in and doing an audit and going in through all of their books and underwriting the deals. Because if they find out that some of the collateral that is securing that loan has lost value, the bank examiner will tell that loan officer, you need to find more collateral to protect this loan. And that's when those local lenders will start knocking on the doors of the multifamily investors saying, hey, we need more collateral. And if they can't put it up, the bank will start foreclosure proceedings against you. All right. So that's what happens when the values of these properties start to come down. The GSE properties survive, but at some point, their terms come due. And at that point, the seller, the owner of the property, has to pay off that note. And if they can't do it at that time, that's what's called a maturity default. And that's when we, as investors sitting on the sidelines with our friend Warren Buffett, that's when we step in and start going over those types of assets. So those are slowly happening. On my students get my CRM for all the possible places you can find deals. One of them is defaulting loans from CMBS lenders. We have a little tab that they can click on, and every month we update that list of loans from CoStar on banks, on properties that are in default with CMBS lenders. So we can see that. It's a very small list right now. It is going to grow as interest rates continue to creep up, and then cap rates follow suit so that the new investors can get their returns. Then the existing owners are going to have to drop their price, their valuation, and that's when everything starts to come home to roost. So that is what happens on the government-sponsored side, and that's what happens on the local lenders side, what I like to call lovingly Frank's Bank. I say that because MYB, that's Millyard Bank. That's a bank that I invested money into here in my hometown of Nashua, and it's the CEO is Frank Tees, and he's that's why I call it Frank. All these local lenders, I call them Frank Tees, Frank's Bank. So that's who you're dealing with, that local lender. And let me walk you through what typically happens in these types of scenarios. I'm going to take you through a local lender scenario, and I'm going to take you through a GSE scenario as the market crash. And here's what happens. So with the local lender, you sit down there, you write the debt with your loan officer. They come out to see you once a month. They come out to see you every 60 days. You know, that's why people who think that when they come into multifamily or come into commercial real estate investing, they can do subject to existing loans, subject to existing mortgages. That doesn't happen. Your mortgage lender is looking over your shoulder every 30 to 60 days. They are checking on their collateral. They want to see you in the desk behind in the seat behind the desk. They want to know that you were the one involved. You go out and you turn over this property subject to an existing mortgage to somebody else. Those people are going to foreclose on that property faster than you can imagine it, and you still own it. So that's why subject to doesn't work in commercial. That local lender becomes your friend. They are your buddies. And so what happens with the local lender is they are watching. And if the market changes, if I mean, my rents on one of my properties never came down. I think we had to bring it down a little bit, but my occupancy always stayed strong. I paid the mortgage every month, never missed a payment, always paid my bills. Everything was going great, but the cap rates started to creep up because the market had shifted. And the bank says, hey, we get a call from our local lender, our local bank examiner, and well, they want us to get an appraisal on your property, and so that we can show them what it's worth and that it matches what our loan to value is on our books. And now I bought this property about 3 to 4 years beforehand. And I said, okay, so how does that all work? Well, you can use our appraiser. We'll send them on down. You'll have to pay for them, of course. Well, how much does an appraisal cost? Well, he's pretty backed up right now. I think the last time it was about $14,000. I said, I mean, one of my properties is barely hanging on. It's laden with debt. And some months I don't have $14,000 left over to pay extra. So you want me to pay this for you guys to cover your book? Yes, that's how it works. Read the loan documents. That's what it says. We make you pay for this. Okay, all right, fine. I'll pay the $14,000. So I stroked a check. We had the appraisal come in, and we were upside down on that property by about $250,000. Now, we had some good investors. They said, we'll cover that shortfall. So we had to write a check to the bank for $250,000 that they could hold on as collateral so that they could satisfy the underwriting formula with the bank examiner. All right. Property comes due. Note comes due. Market got worse. We can't sell this property for what the note is on it. That's how the market turns so badly. We go to the bank and we say, hey, what do we do here? And the guy says, we got to have to figure out a way that we can get you out of this loan and not have to activate the personal recourse provision in the loan. Now, I teach my students, do not sign personally for anything. And that advice from me to you came about because of the last crash. So I'll tell you this first scenario where we had signed personally. It was a local lender, and local lenders tend to want personal guarantees. So for us to make this loan happen, we had to personally guarantee this loan. That meant that if this market crashed and I lost this property and there was a shortfall, this bank could come after my children's home because I signed personally. Don't do it. This is a business. Keep everything within the business. Don't let it trickle into your personal life or your personal assets. I know that sounds easier said than done, but keep that in the back of your mind whenever you're thinking about getting into these types of scenarios. So we had to rewrite that note. We ended up splitting the note into two. We had an A note and a B note. The A note met the requirements of the bank examiner. It met the 80-20 LTV. The B note was a personal note. The bank kind of like kept it off their balance sheet. And it was all finally said and done when we were able to sell that property and we were able to make the bank whole. They wrote off that B note and I got out of that personal recourse loan. They never came after me for the deficiency. And there was a deficiency. The market had changed that much. And folks, best advice I can give you is the reason why that happened was because I had maintained and built a very good, strong relationship with my lender. We would sit and have lunch. We would share a basket of fries, and we would talk about what was going on. And that's, I can tell you right now, that level of personal relationship and the strength of that is what makes the local lender, the Franks Bank, so incredibly valuable. I still don't recommend personal recourse. That scared the daylights out of me. I would never do that again, because I'm going to tell you about the next story in just a moment. But that is what it's like to work with a local lender. We were able to get out of that deal and survive and make some money on it, and walk away because of that personal relationship. So I'm about to tell you that the other scenario. Let me see. I'm going to see. When did you decide to act on a property in distress in the recession? What numbers determine? So, okay. Well, so that's a really interesting question, Francis. It's not so much you, but you do want to start now acting on that property. And when I say acting on that property, what you're really doing is you're starting to build a relationship with the owner, because it's the owner who is in trouble right now. And whether he knows it or not, that owner is going to be going through some hurt, depending upon where he is in the market and how, what were the terms that he used to buy the property. But the world is changing right now, not as fast as it did back in 2008, but the world is changing, and it creates opportunities for us. And the way to take advantage of those opportunities is to get your nose under the tent, and to get in there early before anybody else does. But the real thing that forces that owner to have to act will be the bank. That's what kind of opens up this logjam of sellers thinking their properties are still worth stratospheric numbers, but the market's way down here, and you can't get a seller to change his tune. Well, he's not a motivated seller. He hasn't had a bank call him up and say, "You better move, pal, because we're coming in to take it in 30 days." You haven't met that seller yet. But if you keep in touch with that seller and all these owners and let them know that, remember, you're in sales. These guys are your customers. The owner is your customer. As a salesperson, the most effective salespersons are the ones that can solve the problem of the customer. Well, right now, some of these customers don't know that they have a problem. But you as a salesperson wants to stay in there and let them know that, hey, when you have a problem, I'm the guy you want to come see, because I can come up with some solutions for you. That's how you want to start going after these properties that in distress during this recession. All right, let me see. Chan, would you recommend the assumable loan that has 5 years left with a 5% rate and has yield maintenance? Okay, so Chan, the first question you have to ask is, how much money do you have to put down? What percentage do you have to put down to get into that note? So I just looked at a deal the other day. Oh my gosh, folks. Geez. Okay, so I have this woman down in Florida who sends me deals, and I look at the deals, and if it's a good deal, I kick them over to my students. I say, hey, anybody want to work on this? Let me know. I'll introduce you to this woman who's a friend of mine. She sent me over this one property. It was a dog. I knew right away. The first two lines, I knew that the owner was in trouble. And it was an assumption. And the reason being is the guy said, I will provide seller financing. Well, you don't lead, if you're selling a property, you don't lead with seller financing unless that property's got a problem. But this guy led with seller financing. He says, 20% down, I'll do seller financing. Okay, but then he tells us you have to assume the existing note. He wants $3 million, and the existing note's for $1.7 million, which means I've got to put not 20% down. For me to qualify for this loan with Freddie Mac, I've got to put 40% down, because you can't do a seller second with Freddie Mac. They won't allow it. So for me to assume this, I've got to put 40% down, unless I can do a supplemental loan. I can do a supplemental loan with Freddie Mac, which will ratchet up the LTV to 80%. So now I don't have to put 40% down. I only have to put 20% down. But Freddie Mac only allows a supplemental loan once in the life of the loan. So this guy's telling me he'll do it on the side because he won't be able to get it because he probably took that one supplemental loan option back when he bought the property. So I knew this property was a dog, and so in this particular, that's why I asked the question: how much do you have to put down to get from the purchase price down to the LTV, or what the outstanding term? Now, keep in mind also, one of the problems with doing an assumption is that there are three parties at the negotiating table. Not like other deals where it's just you and the seller. It's you, the seller, and the bank. And you and the seller can come up with any terms you want. But if the bank doesn't allow it, you're done. So when you look at these types of deals, if you think that you're only putting 10% down, the bank's going to kill that deal too. Because the bank's going to say, you don't have enough skin in the game. We want 20%. Ask me how I know. All right, ask me how I know. It's I've seen it all. Let me just say, what is yield maintenance? Okay, so Quincy softball, Quincy, Mass. You see, when you're doing a government-sponsored entity program like CMBS, commercial mortgage-backed security, you are not getting a mortgage. You're getting a security. And that security has been promised to grandma. And grandma, when she gave the bank the money to go create that security to give to us as a mortgage, they told grandma, the beautiful thing about this investment is we're going to give you this type of return every single year. And they can say that because they know you're going to pay your mortgage every single year. And then when you pay your mortgage every single year, they know, okay, well then a portion is going to go to grandma all the time. Everybody wins. But then you come along and you say, hey, I want out. I want to sell this property. I want to get out. Oh, excellent. What a great idea. You just have a little problem. You see, we have this thing in the contract called yield maintenance, which means that grandma is going to get her yield on her note for the next 10 years. Remember, you signed a 10-year note. For the next 10 years, grandma is going to get it because that's how we got the money from grandma to give to you. We told grandma she's going to get it. So we have to maintain that yield with grandma. Okay, well, how do we do that? Well, it's a big convoluted formula that takes into consideration the interest rate on bonds right now and how many years you have left. And you're going to owe us about $1 million. $1 million. There goes all my equity. This stinks. I hate this loan. So, granted, it was non-recourse, and Charlie Dobens told me to never sign a personal recourse loan, but now I got to get out of this. Yeah, I know, but here's a way you can do it. You got to find some other idiot more stupid than you are and have him assume it and let him pick up the yield maintenance. And so that is Quincy softball, what yield maintenance. It's essentially a prepayment penalty on a loan, but for commercial mortgage-backed securities. Yield maintenance, defeasance. If you ever want to know how much the number is or how bad the penalty is going to be, I recommend you go to a website called Defease with Ease. DEFEASEWITHEASE. Just Google it, all right? The fees with these, they've got a calculator in there. You put in the terms of the loan, and they'll tell you approximately what the penalty is going to be for that particular property, for that particular loan. So that's what it is. 35% down. Okay, so you got to come up with 35% down. That nowadays in today's market, that's I wonder if it's an ugly property, but I don't like the 5-year window. I really wouldn't get into a mortgage today unless it was 7 to 10 years, and I like 10 years. It just gives you a lot more protection because we don't know what's really happening with this mortgage, with this market. I wouldn't put myself in a position where I've got a 5-year window. 5 years was always my minimum, but that was in a good market. In today's market, that's too risky. I wouldn't do that. Let me see. That's 5. What are you including seller equity? What? So seller equity, that means, but you're gonna buy into that property by paying off the seller with 35% down so he gets his equity. I think that's what you mean. I still need to check with the lender terms requirements to assume the loan. Yeah. That's a I don't like assumptions. I think I actually have a particular letter of intent that my students have for assumptions, because there are some things in there that you have to, let me give you an example of one thing. Let's say everybody understands what reserve replacements are, right? What are your reserve replacements? $350 per unit per year reserve replacement. So that means that when you pay your mortgage payment, a portion of your mortgage payment, 1/12 of $350 per unit times the number of units, gets set aside in a bank account with the bank so that you can use it to pay capital expenditures on your property based upon their list of what capital expenditures are. So you are essentially taking money every month, putting it in a bank account at the bank to only be used to protect the bank's collateral. I tell you, the banks have it coming and going. So you can only use that money. And you don't have to use that money. You can just let it sit there. So let's say at the end of 3 years, the guy's collected $200,000 in reserve replacements that he hasn't spent on the asset. If you go into an assumption with that seller and you don't figure out what's going to happen to that $200,000 in your contract, let me tell you what's going to happen to it. 3 parties are going to sit down at the closing table, you, the seller, and the bank. The bank is going to sit there, write a check for $200,000 and give it to the seller and say, "Thank you very much for doing business with us. We wish you the best." The seller takes that $200,000 and walks away along with that 35% equity, Chan. Then the bank turns to you and says, "Hey, Chan, let's get started with our new relationship. Stroke us a check for $200,000. And you're like, "What do you mean? I'm new here. I'm just signing up." "Oh, no. That $200,000 that he walked away was reserve replacements to protect our asset. That means our asset has not had $200,000 to fix it up like it should have. So we need your $200,000 to replace that $200,000. And you think to yourself, wait a minute, had I not done this seller a favor by protecting him from having to pay the yield maintenance, I would have gone out and got a new mortgage. And I wouldn't have had to come up with $200,000. But now you're telling me I do. That's crazy. So what we do in our letter of intent, are one of the 4 additional terms that we put in there, is we say the seller has to either transfer whatever is in the reserve replacement at the closing table to us, or they have to spend it down to zero by the closing date. And they can only spend it on the property. So you win either way. You win either way, but you have to offer that and put it in the terms at the offer table when you make your first offer. All right. Oh boy. All right. Let me see. Let me take a little break here because I want to talk about what's coming up for and then I'm going to talk to you about a property that I actually had and the punchline to the story. I'm going to try to get everybody out of here by 5 o'clock. I promise. We'll see. Okay. So, Multifamily OS, my system it's essentially how to build a multifamily real estate business. It's like you're buying into a franchise. We've built all the systems for you. My employees will be working for you on the sales and marketing side. We've created the acquisition management, the asset management, and the property management, and we're teaching that as you go through the process. We're having our first conference, post-COVID conference in Florida on, on Florida, July 10th and 11th. It's a Saturday and Sunday in Fort Lauderdale. You can go to multifamilyos.com and click on events. That website will be live this week. We have the whole idea is how to teach you how to build the business, because that is what you're going to use to leave the legacy to your children. I tell the story of one of the greatest, June and July. Melanie, it is June for the Multifamily OS program. That's the first open to the public conference. My students in the mastermind will be with me the 2 days before. We have an EOS integrator, that's employer operating system. That's Gino Wickman's program that teaches companies how to build their businesses the right way. As you know, it's designed for entrepreneurial companies with 10 to 200 employees. And I'm telling you right now that obviously many of us, that's not the size we're starting out with. But I have negotiated with EOS to have one of their top integrators come in, and for the mastermind, my students are going to be sitting with that integrator all day, learning the business, learning how to set up a business the right way. That same integrator is going to stay over on Saturday. She's going to be my keynote speaker on Saturday to teach all the people in that room. In addition, on Sunday, I have a professor of economics coming in to teach about the law of economics and this professor happens to be a multifamily investor, and he knows the business and he knows how to pitch it. And he's going to be teaching about the market and what's going on, while I am also showing you how the Multifamily OS system is designed to build your business and a turnkey model so that you can get started in this business. So it is, my program and how I teach is different than a lot of these other guys that you're hearing about out there who are teaching about passive investing through syndication. I'm like, yeah, okay, that's one of the tools in my students' toolbox. But what's more important is that you learn how to build the business that's going to be, that you'll be able to live that lifestyle and pass it onto your kids. You do not pass on a legacy as a syndicator. That is essentially what I consider to be multi-level marketing for multifamily investors. And if you're looking to build a business and be your own boss, that's what the Multifamily OS program is all about. There'll be more coming out about it next week. Over the course of this week, we'll be coming out with the actual website. Now, that's my first event open to the public. The second event that's open to the public is July, thank you, Melanie, July 28th and 29th in Chicago. This is the Hotel to Apartment Conversion Summit. Dave Peters, one of my students, and myself will be teaching that program, and it'll be teaching you how you can start getting into the hotel conversion business. I'm telling you, folks, you've heard everybody talking about workforce housing. You've heard everybody talking about how the price of apartments is going crazy. Right now, because of COVID and people are not traveling as much as they used to, so many of these hotels, great locations, are in distress. They're dropping the keys back on the banks back on the desks of the banks, and they're getting out. And what we're doing is essentially, it's a building recycling business. We're recycling recycling hotels into multifamily property for lower income workforce housing people. It is a win-win-win for everybody. And we're going to be teaching that at the hotel conversion in Chicago. That website will be coming up right behind it. So if you're here, if you've been following me, you'll see that I put that. I'll keep promoting this. Oh, and here's the thing. I don't speak in these banquet rooms where I just keep selling seats and there are, they just keep adding chairs. In Chicago, it is at the Oak. Oh, if somebody can, it's a golf course and resort, Oak something Hilton out in Chicago. I've spoken there before. I taught there before. It's a 145 seat amphitheater. That's where David and I are going to be teaching. It's going to be like a law school classroom for the weekend. And it's open to 145. That's it. It's not, when I say the seats are limited, seats really are limited. It is a capped room. Same is true in Fort Lauderdale. It's 150 people in Fort Lauderdale. And 40 of my existing students are already invited to come over for the second event that weekend. So my clients are there from Thursday and Friday for the mastermind session, and then they're welcome to stay on for the 2 days where we have the professor speaking. So all of this will be spelled out in the sales page. Stay tight. I'm going to really advertise the daylights out of this thing. I want to get this filled up as quickly as possible. ML. Francis says ML, and looking at Fort Lauderdale now. Cool, John. Cool. All right. So let me tell you folks about what it's like to lose a CMBS property. Okay. This is one okay, so the way this, I'll give you the real down and dirty on this one. Yeah, I got 15 minutes. I'm going to give you the real down and dirty on this one. Let me take a swig. Back 2006, 2007, my wife and I were buying properties. We're very successful. We're doing very well. And we got a good reputation. We had a good name that we knew how to do these deals. So people are always looking to partner with us, like, hey, we'll go out there and find the money and you go find the deal and we'll put it all together and it'll be great. So we entered into this partnership. There were 5 of us. Well, my wife and I were 2 of the 5. And God, we spent 6 months with this particular group with a business consultant to map out what everyone's roles and responsibilities were. And I'm not kidding. Every week we had to go through the whole process. Oy vey. We finally got it down to what everybody's roles and responsibilities. One woman's role was to go out there and raise money. Well, when it was said and done, she raised nothing. But she got 20% of the partnership because that's how we structured it. Big mistake. Other guys had different tasks. All right, fine. We buy the property. We get an acquisition fee of almost $250,000. Everyone's doing great. It was about a $7.5 million property, 222 units. 2 months after we buy that property, Fannie and Freddie filed for bankruptcy. The world changed. That's how quick it really changed overnight. And we had a 5-year term on that note. And after the market tanked, and we all came to the realization that we're not going to make any more money off this property. We're not going to be able to pay the investors. The market is gone south. The other 3 members who had those incredible job descriptions that we spent every other Wednesday with the business consultant designing, they up and left. They were gone. We never saw them again. We really didn't. And let me back up a little bit. In order to make this deal happen, we asked for the seller to give us a second mortgage. And they said yes, $350,000 at 3%, 3-year term. CMBS note, 5-year term. As you can see, we've done everything wrong in this deal so far. 2 weeks before we had to get, 2 weeks before we closed on that deal, when the bank called us to tell us, congratulations, you've been approved, they then proceeded to inform us that, oh, there's also one thing. There's a second mortgage in the purchase and sale agreement for $350,000. Yes, that's right. It's been in there for the last 60 days when we told you about it. Yeah, well, we're here to tell you that we don't allow second mortgages. And so you're going to have to come up with another $350,000 somewhere else. 2 weeks to go. We've already raised $2 million. We're like, wait a minute. What are you talking? We need some help here. The seller, this is when we go back to the seller with our hat in hand because we've lost control of the deal. The seller can tell us to go pound sand. I'll see you at the closing table, or I'm going to keep your $70,000 earnest money deposit. We have lost control of the deal. We go back to the seller. Hey, we're approved. Everything's looking good. Little problem, that second mortgage. Yeah, they're not going to allow us to do it. And what we ended up doing, and we found out later, we ended up rewriting it as a personal guarantee loan. Secured not by the property, secured by us personally. Okay? The property, we keep the property going. 3 of the 2 partners, my wife and I are the only ones that stayed in the deal. Everybody else hightailed it out of there. We stay on there. We know we're not going to get paid. We do everything right. We pay all the bills. We kill ourselves with that property. That thing was a great lesson. Let me tell you that. Note comes due. Market's tanked. There's no way. We need over $1 million to bring this thing back up to level, and no one's coming up with $1 million. So we go in for a meeting with the bank. The bank was Walker and Dunlop. They are a DUS lender, delegated underwriter and servicer. And we all sat down, all gentlemen and ladies, and we talked about what's going on. And they said, okay, well, I guess, you just want to give us the keys? Or, I mean, I don't think you really want to go through a judicial foreclosure. And we're like, well, whoa, wait a minute. No, just give us some more time here. Maybe we can rewrite the note. We've never missed a payment. We've been working so hard on this property. Yes, we've noticed that. And we're actually surprised you lasted as long as you have. And we really appreciate it. You guys are great customers. We want to do business with you again in the future. By the way, as an aside, I love Walker and Dunlop. They are absolutely a phenomenal company. And I said, no, we just need more time. We just went through the similar situation with another bank, Frank. We were at Frank's bank, and Frank was able to restructure the note, and we're able to keep it. And we're in good graces with Frank. No, we're not like Frank's bank. We are a DUS lender. We're Fannie. We're Freddie. These aren't mortgages to us. These are securities. We know you've done a great job, but we're just going to take the property back. Oh, come on. It's us. Let's go out and have some French fries. Now, you're one of 1 million banks, 1 million loans we have out there. We don't really care. We're just going to take the property back. And that was the end of it. And that's what happens when you're dealing with a government-sponsored entity. You're dealing with the government, or you're dealing with Frank's Bank in a recession. So for those of you that are involved in a recession right now, or you're in the properties, you bought the property the wrong way, I'm telling you right now, if it's a government-sponsored loan that you have, you can either start lining up your money to bring your property up to the loan amount, so that you can get out of the loan maturity default and you get to keep the property and survive another day. Or if you can't do that, the bank's just going to take the property. That's how it works. If you went with a local lender, start kissing ass. Start inviting them out for French fries. Make it work, because you can save that one. And let me give you the punchline on all of this. I was on Cornelius Cannon's Shark Pool. I've told the story before. And listening to these two guys are out there trying to do a deal in, it was in North Carolina. But, giving their CV, they, are telling, and we own a portfolio in Lexington, Kentucky, and in Raleigh, North Carolina. And then he puts up on the screen on the Zoom call pictures of his properties. And I was like, wow. Huh. That guy owns that property that I lost to the bank. He now owns it. And while I was on the call, I jumped on my CoStar and I pulled up the report and I looked at it and I could see the sales history on that property. It started when I bought it, because that was a CMBS note. So it was reported back then. It showed that I purchased it for $7.5 million. And it shows the bank took it back at 6.1, which was the loan value. And it shows a year later, the bank sold that property to an individual. Wasn't even an LLC. The guy took it in his own name for $3 million. $7.5 million, $3 million. And they turned around, they sold it. The guy sold it 3 years later to these guys for 7.2 or 7.3 million. He made 4 point some odd dollars that should have been mine. And that's because, for those clowns who say that you can always make money in multifamily because the prices never go down. Example one of how that guy doesn't know what he's talking about, because he wasn't old enough to be in this business back during the last crash. I heard another guy say that real estate always makes money. You just have to own it when it does. And that guy behind me owned it when it did make money. Let me see, Chan. I still need to check with the lender terms requirements. Okay. Yep. Oh, I think I'm looking at Florida now. Deborah, Mel, I sent you the June 8th agenda via email so far. Cool. All right, Mel. Yeah, come down, Mel. You're getting the invite to the mastermind, Mel, and you were there last time, so I expect you here again. This one's going to be great. Let me see, John. But would you be here guiding us if you pocketed that $4.5 million? Oh, come on, John. I've made it up in other places as well, but yeah. That still hurts. I believe me, I've made money. I've lost money. Anyone that sits here and tells you that they've never lost money in this business, has never been in real estate long enough. And I tell you, I had a podcast today. Nice guy, very nice guy, young guy. I think he's in his early 30s. He said he got started in real estate in 2015 and he's done so incredibly well. Batten down the hatches, pal. It's going to be a very bumpy ride. And I've been through 4 of them already. So, success is a lousy teacher. And as a matter of fact, with this guy, I asked him the question. I said, tell me about your failures, because that's where you really learn. I think I sat here today and I told you that story. And for many of my students who are on this call, I'm sure you have picked up on a lot of lessons that I pound into your head that I learned on that particular transaction. All right. Wow, I'm coming right in on time. I'm going to go back and start putting together the final crunch. Oak Brook Hills Resort. Thank you, Deborah. That's where it's going to be. It's got a nice golf course. And we're going to be there on Friday and Saturday. David Peters and I. David Peters is one of the smartest people that I ever meet. We always jokingly say he plays chess while all the rest of us are playing checkers. And he is one of my students. He's in my Multifamily OS program. He is an expert at hotel conversions. He's now up to 62 employees for all the hotels that he owns around the country. I'm invested in a couple of his deals. They are phenomenal deals. Let me just give you an example, folks, just so you can know what we're talking about. We're going to teach you about what makes a good building, what makes a good hotel what makes a hotel right for conversion to multifamily. They're not all the same, and the due diligence process is entirely different than multifamily. But in this particular case, the property that we're invested in down in Georgia is we purchased it at $39,000 a door, fully renovated, and they're all going to be converted into one-bedroom units. And you can imagine what happens when you take that type of property. Just do the math. If it's $800 per unit, where am I? Just do the math here. $800. So 77 units times $39,000. So we spent $3 million to buy this hotel. If we get it up to $800 a month times, let's say I think it's about, we'll say a 45% expense ratio times 77 times 12 divided by 0.055. That's a $7.4 million valuation. And we bought it for $3 million. John, Racine, do those numbers sound familiar? We bought it for $3 million, and we can value it at 7.4 as soon as we do the conversion. No rehab whatsoever. That sounds a lot like that deal I just told you about. This time, I'm on the winning side. And so I think there's going to be a lot of the, oh, is it really, Bill? Bill, I heard they got a great steakhouse there. Oh, I'm teasing you. But that's what's happening. Those types of deals that I lost back in 2008 are back on the market now, and we're going after them, and we're going to teach you how to do it. We're going to show you how you can invest with David. It's just going to be a great class, and that's going to be a really, as David Peters says, 2023 is the year of the hotel conversion, and I believe him because he's seen these things come up left and right, and he just doesn't have enough time. And he really wants to go after it. So watch for that one too. I'll be telling you more about that. That one's going to fill up. Let me see. I can't, I don't know how, this isn't like Zoom where I can go share my screen. I'm sure Molly would know how to do it, but I was going to show you a picture of the room, but go to the Oak Brook Hills Resort, Hilton in Chicago, click on their meeting rooms. When you see the amphitheater, that's where we will be. Yep. And because it's not like around anything, I'll be buying your lunches so we can all stay together and keep working because there's so much to cover. I mean, the first thing we're going to be talking about is, first off, where these opportunities are, why there are opportunities. And the second thing is the terminology. You have to learn a whole new language when you're talking about hotel conversions. It's fascinating, absolutely fascinating. So, all right, everybody, that is it for me. That is it. And so I thank you all for being here, and I will see you all this time next week. And if anybody, I think we have topics. I think Molly, I think we're going to be talking maybe about the event in Fort Lauderdale. I think I might have the EOS integrator on so we can talk about building a multifamily business. We'll see. Well, it'll be good. It'll be another great topic. All right, everybody. Great to see you all, and we'll chat later. Thanks, John.